Section 4.1 to 4.2 Strategies for Investing in Emerging Markets. 4.1 Asset Allocation and Diversification. Emerging markets play a crucial role in portfolio diversification by offering unique investment opportunities that can help spread risk and enhance overall portfolio performance. Here are several reasons why emerging markets are considered important for portfolio diversification. Low correlation with developed markets. Emerging markets tend to have a lower correlation with developed markets, meaning their performance does not always move in tandem with developed economies. This lower correlation provides an opportunity to diversify portfolios and reduce the overall volatility of investment returns. When some markets are experiencing downturns, others may be performing well, thus balancing the overall portfolio performance. Faster economic growth. Emerging markets often exhibit higher economic growth rates compared to developed markets. Their expanding middle class, increasing consumer spending, and infrastructure development can drive corporate earnings and investment opportunities. Investing in these markets allows investors to participate in the growth potential and capture higher returns that may not be available in mature economies. Access to new industries and sectors. Emerging markets can offer exposure to industries and sectors that are underrepresented or less developed in developed markets. These sectors may include technology, telecommunications, consumer goods, financial services, and renewable energy, among others. By diversifying across markets, investors can gain exposure to these growing industries, potentially benefiting from their future growth and innovation. Demographic advantage. Emerging markets often have younger and growing populations, which can drive consumption, labor productivity, and economic growth. This demographic advantage can translate into investment opportunities across various sectors, such as retail, healthcare, education, and entertainment. Investing in emerging markets allows investors to tap into the potential benefits of demographic shifts and changing consumer preferences. Undervalued asset opportunities. Emerging markets can offer opportunities to invest in undervalued assets. Some emerging markets may experience periods of undervaluation due to factors such as market inefficiencies, mispricing, or negative sentiment. These opportunities can provide attractive entry points for investors seeking long-term capital appreciation as markets stabilize and valuations reflect the true potential of the assets. Portfolio risk mitigation. Including emerging markets in a diversified portfolio can help mitigate the risk associated with concentration in a single region or market. By diversifying across developed and emerging markets, investors reduce the risk of being overly exposed to the performance of a specific country or region. Spreading risk and potentially enhancing risk-adjusted returns. Increasing global influence. Emerging markets are becoming increasingly influential on the global stage. They account for a significant share of global GDP, population, and consumption. As their economies and markets mature, emerging markets may become more integrated into the global financial system. Investing in these markets allows investors to participate in their growth and align their portfolios with global economic trends. It is important to note that investing in emerging markets carries its own set of risks, including political instability, regulatory uncertainties, currency fluctuations, and liquidity challenges. Therefore, it is essential for investors to carefully assess these risks, conduct thorough research, and seek professional advice when considering investments in emerging markets. Overall, including emerging markets in a well-diversified portfolio can provide investors with exposure to unique growth opportunities, lower correlation to developed markets, and potential risk reduction, contributing to a more balanced and resilient investment strategy. Optimal asset allocation strategies depend on an individual's risk tolerance, investment objectives, time horizon, and financial circumstances. Here are some key factors to consider when determining asset allocation. Risk tolerance. Risk tolerance refers to an investor's ability and willingness to withstand fluctuations in investment values. It is essential to assess your risk tolerance to determine the proportion of your portfolio allocated to different asset classes. Generally, investors with higher risk tolerance may allocate a larger portion of their portfolio to riskier assets, such as stocks or emerging markets, while those with lower risk tolerance may allocate more to relatively stable assets, such as bonds or cash. Investment objectives. Investment objectives vary depending on individual goals, such as wealth preservation, income generation, capital appreciation, or a combination of these. The allocation of assets should align with these objectives. For example, if the objective is long-term capital appreciation, a higher allocation to equities and other growth-oriented assets may be appropriate. If the objective is income generation or capital preservation, a greater allocation to fixed income investments or less volatile assets may be preferred. Time horizon. The time horizon for investment goals is another crucial factor in asset allocation. Longer time horizons allow for more aggressive allocation, as there is more time to recover from short-term market fluctuations. For shorter-term goals, a more conservative allocation may be suitable to minimize the impact of market volatility. Diversification. Diversification is a fundamental principle in asset allocation. Allocating investments across different asset classes, sectors, regions, and currencies can help reduce risk and increase the potential for returns. Diversification spreads risk and helps capture opportunities in different market conditions. The specific asset classes and their weightings within the portfolio should be based on the investor's risk tolerance and investment objectives. Regularly rebalancing the portfolio is important to maintain the desired asset allocation. Over time, the performance of different asset classes may cause the portfolio to deviate from the original allocation. Rebalancing involves selling overperforming assets and buying underperforming assets to restore the desired allocation. This disciplined approach ensures that the portfolio remains aligned with the investor's risk tolerance and investment objectives. Consideration of investment vehicles. Different investment vehicles, such as mutual funds, exchange-traded funds, ETFs, or individual securities, offer varying degrees of diversification, liquidity, and costs. Consider the benefits and drawbacks of each investment vehicle when determining asset allocation. Additionally, the choice between actively managed funds and passively managed funds can impact asset allocation strategies. Regular review and adjustments. Regularly review the performance of the portfolio and reassess your risk tolerance and investment objectives. Changes in personal circumstances, market conditions, or economic outlook may require adjustments to the asset allocation. Staying informed about market trends and seeking professional advice can help make informed decisions about potential adjustments to the asset allocation strategy. Remember that asset allocation is a dynamic process, and it should be periodically reviewed and adjusted as necessary. It is important to note that asset allocation does not guarantee profits or protect against losses, and investors should carefully consider their own risk tolerance and consult with financial advisors to determine the most suitable asset allocation strategy based on their unique circumstances. 4.2 Investment approaches. When it comes to investing in emerging markets, investors have the option to adopt either an active or passive investment approach. Here's a comparison of active and passive approaches in the context of emerging markets. Active investment approach. Active management involves selecting individual securities or actively managed funds with the aim of outperforming the market. Active managers use research, analysis, and their expertise to identify undervalued securities or take advantage of market inefficiencies. In emerging markets, active managers can leverage their knowledge of local markets, economies, and political dynamics to potentially uncover attractive investment opportunities. Active managers have the flexibility to adjust their portfolios based on changing market conditions, which can be beneficial in volatile emerging markets. However, active management typically incurs higher fees, as it requires more resources for research, analysis, and portfolio management. Outperforming the market consistently is challenging, and not all active managers are able to generate alpha, excess returns, consistently over the long term. Passive investment approach. Passive management, also known as index investing, aims to replicate the performance of a specific market index, such as an emerging market index. Passive investors achieve broad market exposure by investing in index funds or exchange-traded funds, ETFs, that track an emerging market index. The main advantage of passive investing is lower fees compared to active management. As there is no need for extensive research or active trading, passive investing offers diversification across a broad range of securities within the index, reducing individual stock-specific risks. In emerging markets, where there may be limited information or liquidity challenges, passive investing can provide a cost-effective way to gain exposure. However, passive investing does not seek to outperform the market, so it may not capture the potential upside of select outperforming securities or take advantage of market inefficiencies. the choice between active and passive investment approaches in emerging markets depends on various factors, including an investor's risk tolerance, investment objectives, time commitment, and belief in the ability of active managers to consistently generate alpha. It's worth noting that some investors adopt a hybrid approach, blending both active and passive strategies within their portfolios to capture the benefits of both approaches. Regardless of the chosen approach, investors should consider conducting thorough research, understanding the risks associated with investing in emerging markets, and aligning their investment strategy with their long-term objectives and risk tolerance. Consulting with a financial advisor can provide valuable insights and guidance in selecting the most suitable approach for investing in emerging markets. When it comes to investing, there are various investment vehicles available, each with its own pros and cons. Here's an overview of the pros and cons of mutual funds, exchange-traded funds, ETFs, and direct investments. Mutual funds. Pros: professional management. Mutual funds are managed by professional fund managers who conduct research and make investment decisions on behalf of investors. Diversification. Mutual funds pool money from multiple investors and invest in a diversified portfolio of securities, spreading the risk. Accessibility. Mutual funds are easily accessible to individual investors, with relatively low minimum investment requirements. Liquidity. Investors can typically buy or sell mutual fund shares at the end-of-day net asset value (NAV) price. Cons. Fees. Mutual funds charge management fees and other expenses, which can reduce the overall investment returns. Lack of control. Investors have no control over the individual securities held within the mutual fund portfolio. Capital gains distributions. Mutual funds may distribute capital gains to shareholders, resulting in taxable events even if the investor did not sell their shares. Exchange-traded funds, ETFs. Pros: diversification. Like mutual funds, ETFs offer diversification by investing in a basket of securities. They can track an index or a specific sector, providing exposure to a specific market segment. Liquidity. ETFs trade on stock exchanges throughout the trading day, offering intraday liquidity and the ability to place limit orders. Transparency. ETFs disclose their holdings on a daily basis, allowing investors to see exactly what they own. Lower fees. ETFs generally have lower expense ratios compared to actively managed mutual funds. Cons. Trading costs. While ETFs offer liquidity, investors may incur trading costs, including brokerage commissions and bid-ask spreads, premiums or discounts. ETFs can trade at a premium or discount to their net asset value (NAV), potentially resulting in unexpected pricing discrepancies. Tracking error. ETFs that track an index may not perfectly replicate the index's performance, resulting in tracking error. Direct investments. Pros: control and flexibility. Direct investments provide investors with direct ownership and control over individual securities or assets. Potential cost savings. With direct investments, investors can potentially save on management fees and expenses associated with investment vehicles. Tailored portfolio. Direct investments allow investors to build a portfolio that aligns specifically with their investment objectives and preferences. Cons: research and expertise. Direct investing requires research, analysis, and expertise to make informed investment decisions. Concentration risk. By investing directly in individual securities, investors may face higher concentration risk if the portfolio is not adequately diversified. Time and effort. Direct investing can be time-consuming, requiring ongoing monitoring, analysis, and decision-making. It's important to note that the suitability of each investment vehicle depends on an investor's financial goals, risk tolerance, investment knowledge, and time commitment. Some investors opt for a combination of these vehicles to achieve diversification, manage costs, and align with their investment strategy. Consulting with a financial advisor can help determine the most suitable investment vehicles based on individual circumstances and objectives.